Welcome back. Okay, today we're breaking down the charts and pulling apart what is arguably one of the most famous and, let's be honest, frequently misunderstood tools in technical analysis. Yep, we're talking about the Relative Strength Index, or RSI. Now, a lot of people treat this thing like it's some sort of magic bullet for buying and selling, but as we'll see from our sources, it's actually a highly specific tool just for measuring momentum. So let's decode how the pros actually use it.
Here's the roadmap for this explainer. We're hitting the RSI basics, the 60-40 modern shift, the reversal strategy, how to combine it with an SMA, the big divergence debate, and wrapping up with the golden rules. Okay, let's dive right into this.
Section 1. RSI Basics and Core Mechanics.
All right, first things first. The RSI is fundamentally a lagging indicator. It doesn't predict the future, it's just trailing behind price action to give us a mathematical snapshot of market momentum. It's constantly oscillating on this fixed scale, right, from 0 up to 100. So when an asset drops sharply, the RSI tanks with it, signaling it might be quote-unquote oversold. And when the price spikes, the RSI climbs up near 100, meaning it might be overbought. But here is the thing to remember. Price is always king. If the price goes up, the RSI goes up. It's reacting to the market, not leading it. Now, if you pop open the settings on your RSI indicator, you're going to see a default input number, and that number is 14. What this means is the indicator is basically looking back at the last 14 periods of closing prices to figure out its current value. So, on a daily chart, that's 14 days. On a 5-minute chart, it's the last 14 5-minute candles. Our sources stress that while, sure, you can tweak this, 14 is widely considered the absolute best baseline across practically any time frame. It just gives you that perfect sweet spot. It's not too jumpy, and it's not too sluggish.
Moving on to Section 2, the 60-40 shift and modern parameters. So, how do we actually define those overbought and oversold levels? Well, for decades, the standard playbook was to set your upper band at 70 and your lower band at 30. RSI crosses 70, you look to sell. Drops below 30, you buy. But modern, super-fast markets have kind of changed the game. Expert traders are now shifting those bands to 60 for overbought and 40 for oversold. Why do that? Well, by narrowing that trading zone, you're actually capturing momentum breakouts a lot earlier. If a strong trend pushes the RSI above 60 and it holds that line of support, the market is showing serious strength, not just an overbought condition. This tighter 60-40 window basically helps modern traders spot those structural shifts way before the traditional 70-30 folks even wake up.
Section 3, the reversal strategy and pulling the trigger. Now, what's really interesting about this next tactic is that it flips beginner logic totally upside down. A novice trader sees the RSI blast out of the upper band and just instantly hits the sell button because, hey, it's overbought, right? But actually, in a strong trend, an asset can stay overbought for an incredibly long time, which will just completely wreck your account. The pro reversal tactic, it's all about patience. You let the RSI break outside the band, just let it run wild for a bit. You only enter the trade when the RSI crosses back inside the band. That snapback into the zone is your confirmation that the extreme momentum has finally exhausted itself, and the reversal is actually on. It's a literally crucial layer of safety.
All right, Section 4. Combining with SMA to increase accuracy.
So this 3-step combo is a total game changer. Step 1, throw a 200-period simple moving average, or SMA, onto your chart. This is your absolute compass. If the price is below that 200 SMA, you're in a downtrend, and you are only looking to sell. No exceptions. Step 2, look down at your RSI. Since you're in a downtrend, any upward movement on the RSI is just a counter-trend dip. You actually draw a physical trend line connecting those little upward waves right there on the RSI panel. And finally, step 3, the exact moment the RSI breaks downward through that trend line you drew, you enter your sell trade. By doing this, you're using the SMA to dictate the macro trend, and the RSI trendline breakout to pinpoint a highly accurate, incredibly safe entry that lines up perfectly with it. Okay, but I want you to picture the scenario for a second. You're looking at a chart, the actual price of the asset is just climbing higher and higher, making these new peaks. But when you look down at your RSI panel, the momentum line is literally dropping lower and lower. Price and momentum are in total disagreement. So what exactly is happening here?
Which brings us to Section 5, the divergence debate. Is it a trap or a treasure?
So bullish divergence happens when the price is trending down, but the RSI is creeping up, hinting that upward momentum is secretly building behind the scenes. Bearish divergence is the exact opposite. Price is climbing, but the RSI is falling. Our sources use this brilliantly vivid analogy for this bearish setup. They call it the bear mouth. Imagine drawing a line connecting those rising price peaks and another line connecting the falling RSI peaks. That gap between them widens just like a giant bear's open mouth, signaling that the bear is about to snap its jaws shut and drag the market straight down. Visually, it is an incredibly compelling setup. However, and this is a big however, other expert sources issue a very stern warning. They say divergences are a trap for beginners. The argument here is that in a genuinely strong, trending market, these divergences will often just fail completely. The price will keep ripping higher, totally ignoring that falling RSI. Traders who blindly trust that bear mount without waiting for actual price action confirmation, they usually find themselves getting completely run over, taking massive stop-loss hits. It's a really fascinating divide in the trading community between folks who constantly hunt for divergences and those who avoid them like the plague in trending environments.
Finally, Section 6, the golden rules and universal truths.
So, distilling everything down from our expert sources gives us these absolute golden rules. Number 1, never ever use the RSI in isolation. It is strictly a confirmation tool. Number 2, actual price action and candlestick shapes are always king, always. Number 3, you absolutely cannot ignore macro support and resistance levels on the chart just because the RSI looks tempting. And finally, number 4, and this is a great pro tip, look for structural patterns directly on the RSI line itself. Specifically, keep an eye out for M shapes, which signal double tops and resistance, or W shapes, signaling double bottoms and strong support.
Well, we've covered a tremendous amount of ground today, unpacking the RSI from its basic mechanics all the way to advanced SMA trendline combos. But I really want to leave you with this final, provocative thought as you head back to the charts. Are you letting a simple mathematical line blindly control when you buy and sell? Or are you stepping up as the master of your own strategy, using the RSI simply to confirm your robust market analysis? Because the difference between those two approaches, that's the difference between a beginner and a professional. Thanks for joining me on this explainer, and